Over the last few weeks, we've talked a lot about what the best safe haven is, gold or Bitcoin. And what we ended up learning is that it's probably a combination of both that's gonna help save you in the next financial crisis. But in the short term though, how do you profit off playing them? Recently on Real Vision, we interviewed legendary gold investor John Hathaway. We're gonna break down his conversation on this week's episode of Real Vision's The One Thing. What's going on, investors? AK here. The other week we learned that it probably makes sense to hedge your bets with both gold and Bitcoin. For long-term safety, you could get some physical gold and then also hold some Bitcoin in a digital wallet. But in the short term, it's more complicated to play, so it's a good thing we got our experts to help us. John Hathaway is one of the most successful gold equity investors around. Here he is explaining why gold is his play.
You know, when I hear this thing, you know, in the financial media that the dollar is the best house in a bad neighborhood, I think to myself, this is ridiculous because the neighborhood's going down the tubes. Mm-hmm. And so maybe the dollar is the tallest midget, all these stupid analogies. But at some point, capital will seek out safety, which is what gold represents. And, you know, I have to point out that gold has outperformed every stock market since 2000. I mean, most people don't even think about that.
And that's been in a relatively benign, I mean, over a 20-year period, we've had ups and downs.
Right.
So, I mean, I think that's almost separate from what your view or my view or anyone's view is. It just is a fact that
it's a fact
in the last 19 years, right?
Gold has
Since
outperformed
2000.
bonds and stocks, not only the S&P, but if and gold is at record highs in yen, I think Canadian dollars, the pound, the euro, and Aussie dollars.
Yeah.
And it's just the US dollar where we're still sort of struggling. And it's because the dollar has been relatively strong compared to other currencies.
John might not like the analogy, but he pretty much echoes what Rick Rule said last week. The US dollar is the prettiest mare at the slaughterhouse. When it's time to pay the piper, capital is gonna seek safety, and safety is gold, or Bitcoin for the contrarian. On top of that, gold has actually outperformed both stocks and bonds over the last 20 years, which is pretty surprising because even with the unprecedented economic expansion and a crash or two, gold has still outperformed your more standard assets. So long-term, gold is a viable investment, but only if you're patient and if your boss approves your allocation. But more on that later. What about the short term though? Here's what Hathaway had to say.
The way I've heard it put best, and I've learned after all these years never to put a number and a date in the same sentence in terms of any kind of price.
That's okay. What do you got?
I know we're among friends.
What do you got? Right.
So the way I like to, I thought it was very well put by David Rosenberg of Gluskin Sheff.
Okay.
And David gave an interview with the National Post in Canada. And then he and I sat on the same stage at Beaver Creek and we talked about it further. And what he said, and I think this makes a lot of sense, is that we have a cycle high in bonds in terms of valuation. We have a cycle high in stocks in terms of valuation. And the one major asset class that's been left behind is gold. Mm-hmm. And the interviewer said, would you be surprised by $3,000 gold? Now, this is a guy who's not a gold guy.
Yeah.
He's a rational economist, made his career, you're
Somewhat
shaking your
rational.
head.
Somewhat rational. I mean, I've read his stuff over the years.
Yeah, okay. But anyway, he's a well-respected guy. He's not in the gold camp.
Right.
But he said he would not be surprised by $3,000 gold.
Yeah.
And I think his point was that gold needs to make a cycle high and, you know, pick any number.
So Hathaway and another Real Vision contributor, David Rosenberg, both agree that over the next 18 months, gold could hit 3,000. And on top of that, Hathaway has an ace up his sleeve. I'll let him explain it to you.
I think the fact that mainstream investing, S&P names, tech, stocks, all that has done fine. So why would you venture into something that hasn't performed? And frankly, it's the third rail of investment ideas because I know I've heard of your partner getting tossed out of an office because he was going to talk about gold. He said, don't you dare talk about gold to my team, you know, some RIA in Wisconsin or someplace like that.
Right.
So why is it the third rail? Because it hasn't performed for 6 years.
Though it's the number one performer from 2000. People ignore that.
Memories are short.
Right, of course.
And we understand that.
Right.
But the other thing is that even when I talk to somebody who could allocate to gold, They may do it personally, but they will not do it for their clients because there's career risk. If you underperform,
the stock market.
if you're a mainstream investor and you're 20 basis points, let's say, behind the S&P, and you had a 5% allocation to GLD or GDX or the kind of thing we do, you could get canned. You certainly would find tremendous disapproval.
Okay, well, doesn't that mentality have to change?
Well, there was a time, I remember it, when gold was really doing well, and everybody wanted in at the top.
Yeah.
So
you mean 10, 11, or do you mean
11? Yeah.
78? Okay.
Well, no, I'm old enough, but I wasn't doing gold then.
Yeah.
But that just shows you how cycles work and how psychology changes. So we are kind of just coming out of like a 6-year nuclear winter, and it's hesitation, early stage stuff.
So despite the fact that gold has outperformed over the last 20 years, Hathaway's argument is that allocators are afraid how gold will look in their portfolio to both their supervisors and other investors. What we got here is a contrarian's best friend, human nature. So now that the secret's out, where do you get exposure? Here's Hathaway again.
I think you mentioned before the GDX, which is the Van Eck ETF.
The Van Eck ETF.
On larger gold miners.
Right.
I mean, I looked at the chart recently, and it's at the same price basically that it was in 2008, which is totally crazy given what looks like to be a pretty good future. So what's your sense just broadly about the sector? Why you think, can we go back up to those highs that we were at in 06, 07?
It has to be driven by the gold price.
Okay.
I mean, you look at the fundamentals, and every company has different aspects to it. There's, local political risk. There are so many different things in terms of vetting an asset and vetting a management. But at the end of the day, there's only one thing that really matters, and that's the gold price.
Well, it's also how they manage their businesses.
There's all of that.
Right.
You can't.
Right.
You
but
have
it's
to
not going to have a big move. Without
right. You're not going to get
Yeah.
generalist investors coming into the space unless you have an eye-popping move in the gold price.
But these things are really super cheap. I mean, some of them trading at 4 or 5 times EBITDA.
They're ridiculous, particularly the smaller ones.
Yeah.
And it's almost to the point where, and we figure this, that you can buy a new mine by buying an existing company at a 35% discount to what it would cost, let's pretend you're Newmont or Newcrest or one of them, to start from scratch.
So they're just
the make or buy. You can pay a premium in the market for a single asset company and have it be accretive to obviously the target and also to your own shareholders. And you're saving all that money on building a new mine. So I've never seen that in 20 years of doing this.
Really?
Never seen it. So
wow, that is cheap.
To me, that just suggests that when the psychology changes somewhat, this is again in the corporate suites of the larger companies, that you will see some, not merger of equals, which was Barrick, Randgold, for example, but larger companies swallowing up smaller ones.
So ultimately, a higher move in gold will also move gold mining. The combination of gold potentially being at $3,000 and the consolidation of the mining industry is giving us a great setup. And that's not to mention the psychological disconnect that institutional investors have about gold. So whether you're a contrarian, long-term investor, or short-term trader, gold has an opportunity for everybody. Hathaway suggests getting in early on gold mining equities like GDX to profit from this bull market. If you want to catch this full interview and learn more about gold, make sure you subscribe to Real Vision. I'll talk to you next week.